Kelly, also known as the most famous woman in the world. So today we're going to be talking about something very exciting, which is target date funds. And our last episode talked about Roth IRAs. And so it is pretty fitting that we're going to talk about something that you can put in your Roth IRA. And we are going to be going over a lot of stuff today, folks. So strap in and get ready for launch because this is a deep dive here. So, bullseye on retirement. That's what I'm calling this episode because a target date fund is what it says in its name, which is you have a target date for retirement. And actually, before I even start talking about retirement, because I think that word retirement tends to put off a certain demographic, which is maybe younger people in your 20s or even 30s. And I want to encourage all of my younger listeners to realize that when something says retirement, it doesn't always mean that you can't take advantage of it now. And it doesn't necessarily mean retirement, right? Because it could actually mean financial independence or financial freedom. Because to me, the word retirement doesn't necessarily mean I'm going to retire and then sit around and do nothing. For me, something like an early retirement would mean that I'm financially free to do whatever I choose to do because I have enough cash flowing assets and enough of a nest egg and enough of a safety net to no longer have to work for money if I don't choose to. So don't let this word retirement put you off if you're younger. And it's always best to start as early as you possibly can. So, all right, target date funds are also known as life cycle funds, and sometimes you will also see them as, sometimes you'll see such things as freedom funds. So there's a company called Fidelity that sometimes calls them freedom funds. Or you can even hear sometimes things like target retirement fund, but those are all the same thing. And they are designed to provide a simple, convenient solution for people who want to save for retirement or save for your financial freedom. And in this world, they're often referred to as set it and forget it investments. So target date funds automatically adjust their asset allocation over time based on your estimated retirement date. So what this means is that when you're setting one of these up, you're going to put in your age, and sometimes you're going to put in things like your risk tolerance, and we're going to get into what risk tolerance is in a moment. But depending on the things that, and a lot of these companies have very simple questionnaires that will ask you things like that, like what's your age and what's your risk tolerance. And when you type those things in, they're going to give you some options of how aggressively you want to allocate your assets. And what are we talking about? Asset allocation. What does that mean? That just means that target date funds are made up of stocks and bonds. So a percentage of this, and you can think of a target date fund as a pie, like a pie chart, a pie graph, and a percentage of that pie is going to be allocated to stocks, and the other part of it is going to be allocated to bonds. And when I say stocks, that usually means index funds. So when I say stocks, I'm not talking about necessarily that the target date fund will have 15% Apple and 10% Tesla and then the rest bonds. It's not that. They're going to actually have index funds contained within that pie. So And you can go back to our episode on what an index fund is, but you can have an index fund that, for example, tracks the S&P 500, which is the top 500 performing companies in the United States. And so that is also why target date funds are sometimes known as the fund of funds, because it's a fund that's made up of percentages of different funds. So it's very, very well diversified, right? It's even more diversified than just than just an index fund alone. So when you're younger and your retirement date is farther away, the target date fund will typically have a larger percentage of the riskier asset, which would be the stocks. And the reason for that is because stocks generally have a higher potential for bigger returns. But they're also a little bit more risky because the market can go up and down, and they're more risky than stocks. Than bonds. Okay. It's late here. So stocks are riskier assets to invest in than bonds. Bonds are considered very safe in the investment world. So if you think about this, it makes sense, because if you are a very young person, well, not even very young, you can be in your 20s, 30s, and with that, you're going to have a longer time to make money, and you're also going to have a longer time horizon to dollar cost average into this fund. And you can go back and listen to my podcast episode about dollar cost averaging. But really quick, what that means is that you're going to be putting a set amount of money into this fund every single month. Of course, depending on how much you're making, what your income is. So let's just say you're 25 and you start putting away $100. You start sending $100 a month to this fund. Well, $100 a month over the course of your life until you hit retirement age, which is actually I need to look at the exact retirement ages now. I literally forgot. Full disclosure. I'm thinking 59 and a half just because I'm thinking of Roth IRAs, but I actually need to look at what the United States government has decided our retirement age is now. I believe it's older than that, 60 something. Okay, but anyways, you're going to have a longer time to put that $100 every month and average that over the course of your life until you're into retirement. And so because of that, you have a higher risk tolerance than someone who is maybe only 10 years away from retirement, because that person may have already built up a bigger nest egg and they're not going to want to risk it. And so someone like that may want to have a higher percentage of that pie in bonds, which are safer because they want to protect what they already have, and they're not necessarily very focused on growth. They're more focused, the older you get, the more focused you become on simply protecting what you have. Okay, so this target date fund automatically rebalances this pie every year. And as you get closer to your target date, to your retirement date, the fund will gradually shift to safer assets like bonds to protect your savings. And the reason why this type of fund is very appealing to many people is because the automatic rebalancing means you don't need to worry about adjusting these investments manually every year. And so that's where the set it and forget it comes in, where you just send your set amount every month to the target date fund. And by the way, that can be automated as well, so you don't have to do anything. It's just set it up once and just leave it alone. And it's going to automatically rebalance your portfolio for you. You don't have to touch it. You don't even have to look at it. You don't have to do anything. So Okay, so it's very simple. This instrument is appealing because of its simplicity. And for this, you pretty much just need to set your target date and set your, as I said, your risk tolerance and things like that. And you need to just pick which company you like the most, that you feel is the best for your situation, and that's pretty much it. And then set it and forget it. Another great thing about a target date fund, just overall, is that you are implementing a consistent strategy. So with this, you are automatically implementing a consistent investment strategy for your life, for yourself, that doesn't require you to monitor market trends or to be all over the Reddits and the Quoras and the YouTubes and all of the things trying to make frequent investment decisions. This is not a thing where you're going to be hyped up on YouTube or whatever, looking at graphs and charts and stressing about the NASDAQ being up or down. That's not what this is. This is a consistent investment strategy that you put in place once, and you consistently, on those automatic payments to the fund, you just send it there and you're like good to go. Okay, so backing up, this episode does talk about putting your target date fund in your Roth IRA. And don't get too scared or anything. I promise this stuff is very easy to set up. It's easier than you think, and actually it can actually be quite fun, because it's kind of fun to realize that you're becoming more financially savvy and you're becoming smarter and wiser and learning. And you can click around and see which fund has, which company has a great track record, and kind of compare the companies, compare the different funds, and see which ones have done the best over time. You can Google all that stuff. Actually, you can look up some of this information on a website called Morningstar, but there's just tons of information on that. And just so you know, there's not a I'm sure there's a lot more companies that provide these funds that I'm aware of. But as far as let's say there's a top 7 or so companies that are the biggest and most trusted in this world. And you can just Google that, right? And see the most popular ones, the longest standing ones, the companies that have the best reputation in the industry. For example, some of those companies are Fidelity. Another one is Vanguard. And you can look up some more. Actually, let's give some examples of these guys, actually, before we go into the Roth IRA situation and putting them in your Roth IRA. So examples of target date funds would be, let's say, for example, you can Google the Vanguard Target Retirement Fund Investor Shares, and that usually has a date on it. So you need to put in your target retirement date, but let's just say, for example, this one is the Vanguard Target Retirement 2045 Fund Investor Shares. So I'm sure you can just Google Vanguard Target Date Fund and information will come up. But the symbol for that is VTIVX. And another one would be the T. Rowe Price Retirement 2045 Fund. That's T. Rowe Price. So T, like the tea that English like to drink. T as in Tom, with a period, and then Rowe, ROWE. So T. Rowe Price. Another one is Fidelity Freedom Index 2045 Fund, Investor Class. Another one is Life Cycle. Oh, I didn't give the symbol for those. I'm sorry. The T. Rowe Price one is TRRKX. Fidelity Freedom Index is the FIOFX. And another one example is American Funds 2045 Target Date Retirement Fund Class R5. And don't get all freaked out about the names. It's just a name. The symbol for that one is REHTX. And also be aware that, yes, these things do come with fees. And so, and on tons of websites like NerdWallet, and I'm not sponsored by NerdWallet, but NerdWallet, if you would like to sponsor me, I'm giving you tons of free advertising. NerdWallet.com, you can look up different fees. So what the fees on these things are called expense ratios. So obviously the lower the expense ratio, the less you're going to be paying in fees. And just to give you an example, so the ones that I just listed, the funds that I just listed, the expense ratios range on those from 0.08 through 0.42. So it's kind of it's a big spread as far as in between those types of funds. But you're just going to want to look at it. But again, don't get too caught up in these gritty tiny details. It's, to me, it would be better to spend, let's say, just a couple hours, have fun with it, look, make the best decision. You'll be able to feel it out, read a little bit about the companies, and, just make a decision that day and, just go ahead and go with it. I would rather have you do that than to spend weeks looking this stuff up and then getting freaked out and then feeling like you're not going to make the right decision and then getting so caught up in reading so much stuff that then you just kind of get burnt out and forget to actually start the fund. So the more important thing, instead of nitpicking over is it 0.08 or is it 0.112, the more important thing is to do it and actually get it started and start saving for yourself and start building this nest egg for yourself. Okay, so moving on, why would you want to put a target date fund in a Roth IRA, and how in the heck would you even do that? So first of all, let's go back and just talk a little bit about what a Roth IRA is, even though I'm not going to go super hardcore into that because that was my last episode and you should really check it out because it's dope. So Roth IRAs are simply an account. It's an investment account. And in your investment account, you need to put stuff in it. And those stuffs are investment vehicles, like a target date fund. And Roth IRAs are used because they allow you to have tax-free growth and withdrawals when you're in retirement age for the Roth, which is 59 and a half. And let's see here. Oh my gosh, I'm not going to go into this. I'm like trying to choose how do I simplify my previous episode. But let's make it super simple and just keep it to that, right? People use Roth IRAs because it allows your investments to grow tax-free. I mean, that's the biggest thing that's why people do it. So go back to the last episode and look at a Roth IRA and how to open one. But why should you put a target date fund into the Roth IRA is because you're going to get, again, the tax-free growth. So that means that any capital gains, dividends, or interest earned within that account do not incur taxes, which, there are lots of ways to make money. And if you look at quote unquote making money as 1%ers do, then the best place to quote unquote make money, even though you're not making money, but is to actually save your money by knowing a little bit about taxes. All right. Also, you're going to have tax-free withdrawals, as I just said. Oh, I'm sorry. You know what? I'm looking at my notes. Am I messing this up? Why put let's see here. Oh, no. See, I am messing up my notes, but it's okay, guys, because we're moving right along and this is live and I don't really like to edit these episodes because then it takes way too long and I can't actually get the episodes out. But okay, so long-term growth. Target date funds are designed for long-term growth, and so it's just an ideal fit for the Roth IRA because Roth IRAs are a long-term investment account, and the target date fund is a long-term investment vehicle. So it's kind of like peanut butter and jelly. They're both for long-term. Wonderful. And also, the hands-off nature of the target date funds combined with the tax benefits of the Roth can simplify overall retirement planning. So the whole thing just simplifies for you. Again, there are many advantages of using a target date fund in a Roth IRA. And another one of those things is discipline, because this will encourage you to have consistent long-term investing without panic selling and buying, because you're not going to be the person who is panic selling and buying their Tesla stock when Elon Musk decides to smoke a joint with Joe Rogan. If that happens, you're not going to be like, oh my God, I have all my, I have $100,000 into Tesla. Like, oh my God, what am I going to do? Like, Elon can smoke all the joints he wants with Joe Rogan, and you're not going to be freaking out about headlines because you're putting that same amount of money into that target date fund come hell or high water. It doesn't really matter, right? So it's ease of mind. And yes, there are some drawbacks to using a target date fund. And basically the argument against target date funds is that some people want to manually manage their asset allocation. And so basically this means that there's some people, and that might be you, which is totally fine, who look into the asset allocation of some of these funds, and they believe that they believe that the target date funds, some of them, or maybe all of them, are not aggressive enough in their investment strategy. So they think that the target date funds basically don't put enough of the allocation into stocks, and that the pie has too much bonds in it, just overall, and also when the person is on the younger end of the spectrum. So that basically means that some people just basically think that this investment vehicle is too conservative or too safe, or just basically has too much of that pie in bonds, and that it doesn't offer enough growth. So I completely understand that strategy, honestly. And if that's you, then go on with your bad self, because that is a thing, right? Like if you look at it and you say, well, let's say, for example, well, I'm only 30 years old and I have X amount of percentage in bonds. Why would I want that amount of percentage in bonds when I'm not going to be retired for another 35 years, right? So, and then also there's some investors who believe that you basically shouldn't have like any bonds because they just would prefer that growth, and they believe through their own personal research that having more index funds will pay off in the long run, even if, let's say, you don't have any bonds, or if you only have like 3%, allocated to bonds. These things are just going to depend on who you are. So if you're someone who loves to research and is willing to look at your asset allocation at least once a year and really look at it and adjust it according to how old you are and according to your particular family situation and according to potentially maybe the markets, then go ahead. You can, if you're that person, then obviously that you know how to do your research and everything, and then there you go. But, you know, this type of investment was created for people who realistically, excuse me, I'm over here. Oh my God, this episode is going to be one for the history books. Like, I'm just not caring about editing right now, right? But, you know, it's okay because this is live. I'm keeping it moving. Okay, so this type of investment was meant for someone who just wants to do the hands-off approach and set it and forget it. And yes, I can see that a lot of these funds have a larger percentage of bonds in them than may be the best strategy, but they're trying to protect the quote unquote average person and trying to prioritize that safety. So it's more prioritizing safety over growth. So those are some things that you can definitely consider. And again, I'm not a financial advisor. I'm not an attorney. So definitely look into this stuff yourself. And if you can, go over it with your tax professional of your choice and your attorney or your financial advisor. So again, here's what you should consider. Just to recap everything, here's what you should consider when you're looking at target date funds. Expense ratios. That's how much you pay annually for the fund to be managed. Lower expense ratios can lead to higher returns over time. When you're looking at the different target date funds available, you're going to want to look at the asset allocation. So check how the fund allocates its assets now and how that will change over time as you are getting closer to retirement. Look at the fund family. So you're going to want to look at the overall reputation and performance of the company. And then lastly, one thing that's called the glide path. And don't get all freaked out about this name. It just means that's the rate at which the fund's allocation will change over time. So it's, you know, how that pie is changing every year, that ratio of stocks to bonds. And some funds will shift their asset allocation more aggressively than others. So, you know, we're talking about, I mean, this is just an example, but let's just say one fund shifts their asset allocation, I don't know, 2% from stocks to bonds every year. And then another one shifts it 5%, something like that, right? You're going to want to look at that. So this was a very in-depth episode. I feel like I had like more written down, but you know, now actually talking it out and actually talking with you guys, I'm realizing, you know, this is actually a lot easier to understand than a lot of people, I guess, make it seem. This was fun. I'm having a lot of fun with this. I'm learning a lot myself. You learn new stuff every day. Yeah, I learned a lot from researching this episode, and you know, I learned that this stuff can be very fun. And even though this is called the Millionaire Mentor Method, you know, this isn't actually I guess it's primarily a personal finance podcast, but really it's an overall lifestyle podcast, right? Because it's not about the money, it's about what you're doing with your money. It's not about whether or not you're allocating 10% of your portfolio to bonds or you're allocating 5%. It's about your quality of life on a daily basis. It's about what does your dream life look like? What does it really look like? And how can you get there? And you know, this for me is actually part of my dream life, because I like to feel empowered, and I like to learn things that can directly benefit me immediately. And just being a mentor on this podcast has already impacted my life so positively. Anyways, that was a rant, but thank you. And please like and subscribe wherever you, please like and subscribe. And if you can give me a rating, that would be awesome. If you can share it with your friends and family, that would even be better. And you can please visit our website where you can get matched with a mentor who shares your same passions for free for now. Or you can request to become a mentor to someone who really might need you. And I have a lot of young women who really need female mentors out there. So if you can contact me, we are on all social media. The handle is at Millionaire Mentor Method. You can also contact me on millionairementormethod.com. You can find out more about me by going to themostfamouswomanintheworld.com and looking at all my fun, weird life things. Yes, I am now officially not going to make sense from this point moving forward because I am very sleepy. I'm a very sleepy Krystal. So remember, each one teach one.
The information provided in this podcast is for educational and entertainment purposes only and should not be construed as financial advice, investment advice, or medical advice. The host is not a financial advisor nor a medical doctor or licensed therapist. Any financial or medical decisions made based on the information in this podcast are made at the listener's own risk. It is recommended that listeners consult with licensed professionals such as CPAs, financial advisors, and licensed physicians before making any investment or medical decisions. The host and creators of this podcast accept no responsibility or liability for any loss or damages incurred as a result of the information provided in this podcast.